One, I think that we cannot separate real economy from financial economy. As much as it's easy to send my mother money and she receives it the same day or the same hour, I must have that money in the first place to send. While focusing on the opportunities that Africa can harness to leapfrog into what you can call the digital era, and we are seeing that happening, it must always be connected to the real economy. That means that industrialization still must happen. We need free manufacture, the manufacturing industry and sector. That's the real economy that we need constantly to draw a connection. Trying to draw a connection between the conversation we're having this morning about dismantling the reforms or dismantling or reforming the global financial architecture and the African financial architecture. And there was an important question that was raised in the morning about should our eyes be focusing on the global north or should we be focusing on the domestic or the Africa-specific issues? And I think, again, here there's a very clear connection. Number one, the continent cannot disconnect itself from the global system. Even if we were able to set up all these great initiatives in the continent, they somehow must be connected to the global financial system. And what does that mean? That means that the current control that the rich countries have on the global financial system must be broken. We need to ensure that we are working towards creating transparent, accountable, global financial architecture. And Africa's voice on the table is very important. So the question that was asked by the colleague, which I don't think was answered, about when we are talking about dismantling, what does that mean? That means we need to move away from the current system that speaks about $1, one vote, to one man, one vote. At the UN, ensuring that the global financial system, particularly institutions such as the OECD, such as the Bretton Woods institutions, we were talking this morning about the SDRs and how undemocratic they are. So as we have this conversation about what we need to do domestically, also not losing sight on the need to be in those spaces where those global decisions are being made that have a direct bearing to Africa's capacity to regulate its financial markets and raise domestic revenues. And two last points, Jason, if you might allow. I think that when we talk of the cryptocurrency specifically, I think that on one side there is significant opportunity here. This is a train that the continent cannot afford not to be in. But I would appeal that we approach it with caution because there has been spaces where out of the excitement of what cryptocurrency might mean to the continent, it ends up exacerbating the existing challenges, particularly when you look at it from the angle of illicit financial flows. It's important to note that cryptocurrencies have become the weapon of choice for those that are seeking to shift their profits away from taxation, and the need to putting our house in order in terms of ensuring that we have strong and regulatory framework that can be able to ensure that the cryptocurrencies mechanism is operating in an environment that is transparent and does not encourage illicit financial flows. Otherwise, we'll be cutting ourselves in the sense that we are opening it up for financial deregulation, which actually creates fertile ground for exacerbating the challenge of illicit financial flows. The last point is really the question and this question was asked by the speaker, and I don't think he provided the answer. This is going to be my question to him. Can the CBDC, the central bank digital currency, exist side by side with the cryptocurrency, particularly when you consider that the they're almost an antithesis of each other. Cryptocurrency exists on the basis of anonymity, while CDC means that it needs to be regulated by the central bank. I'm speaking this as a layman, so I would like to hear more perspective about what this means. Are they in competition? What would they mean if you see, for example, in Nigeria introducing the e-naira? I know in Ghana, in South Africa, there are efforts of establishing this kind of state-driven digital currencies that are supposed to be more stable and less volatile. How do these exist in a policy environment where the cryptocurrency survives on deregulation, survives on low regulation and to some extent opacity? So questions around beneficial ownership, questions around know your customer, how would that operate when you have a situation of these two currencies?
I think one important aspect to highlight, which I'm sure some of the speakers wanted to get into, but they just didn't have time, is that it's not just CBDCs versus, say, Bitcoin. There is a broad spectrum of digital currencies, and the number of digital currency has evolved and changed and grown a lot over the past couple of years. What people normally call cryptocurrencies, which are completely unbacked, meaning not backed by any kind of reserves item, like Bitcoin, it's one end of the spectrum. But even within the private sector development of digital currencies, there are other tools like stablecoins, for example, which have a varying degree of backing. And those are much more stable in the valuation than crypto assets. Although, some of them, as recently we've seen with Terra Luna, they don't have complete backing and therefore are subject to a lot of volatility as well. But with this, I would like to say that it's not just either government, central bank digital currencies, which are growing on their own, or Bitcoin and similar crypto assets on the other end of the spectrum. There is a whole array of private sector digital monies that is evolving and that is growing. With respect to your key questions on how can governments navigate through this evolving world, as always, regulation becomes very important. And I fully agree that there should be, if central bank digital currency would really take off, they should not displace private forms of having digital monies. Certainly, it would be important to provide some kind of regulations to the more volatile crypto assets, because you can imagine if somebody with not much information has put all their lifetime savings in the Bitcoin, and the Bitcoin loses 70% of its value, that person will be subject to an incredible financial strain. So it is important that there is some regulation on very volatile assets, as there are on standard assets in terms of how investment tools or banks can advise people towards buying or not buying certain assets. But maybe let me touch on two other key important questions that were mentioned by in the agenda. One is the region ready? Well, there, I have some slides. I'm not sure how easy it is to put them up. And in the interest of time, I'll just mention the content. Unfortunately, Africa, the African continent is somewhat behind in terms of broad internet and in some places cell phone receptions, which are essential for the development of these digital currencies. So that puts the continent at a disadvantage. However, at the same time, there's been similarly leapfrogging to what happened to the telephone technology some time ago. And so parts of the continent, including some specific countries like Kenya to start with, for example, a few years ago, have really gone very, very far in developing a digital revolution, which has created massive financial inclusion and can create much, much more financial inclusion within the continent. And that revolution is important and it continues. To give you an idea, in the African continent, standard bank accounts per say, 1,000 people are much less than in the advanced world. That's not surprising, meaning a bank account when you go to a physical office of a bank. But mobile bank account per 1,000 people are much higher, which means Africa has already reached a certain level of digitalization that advanced economies have not. So there is a tension there. The continent has still some weakness in terms of infrastructure to develop, especially if he wants to really promote financial inclusion through digital services. But at the same time, this process is going very, very fast and hopefully will continue at this pace. The last point I'd like to make is maybe on central bank digital currency regulations that are essential, but I can leave that for later to leave space for other speakers to speak, and I'm happy to come back to it if you would like.
Cryptocurrency is based on blockchain technology. I don't think Ali or Linda mentioned it, but blockchain technology is decentralized ledger systems. So a record in the blockchain technology is traceable and cannot be deleted. So if I do conduct a transaction, for example, crypto is based on blockchain, then that transaction cannot be deleted. What that means is decentralized systems are traceable, they are transparent, and are not easy to tamper with. So then that means crypto and digital currencies are actually more secure in terms of traceability and just you being able to audit it as a regulator. And I think that is usually the biggest problem with regulators. The second issue would be on money laundering and flows of illicit cash. And I know all of us are from countries that have anti-money laundering laws, but how many of those countries actually agree to have crypto exchanges as reporting institutions? Is there any? I don't think I've found any in Africa. I know the UK has has an obligation for all crypto exchanges to be reporting institutions, even though they're not licensed and crypto is not recognized as legal tender, but to curb AML, crypto exchanges have been required to register. The same thing has happened in the US. So there is a way to manage some of the risks that we're talking about in the sense of digital currencies within the laws that already exist. Now, when it comes to the young population and creating trust and also mitigating the risk with regard to digital currencies, I think the biggest issue would be traceability of the transactions. And digital currencies already do have that incorporated by being based off the blockchain technology. And that risk is already mitigated in that sense. With regard to volatility, with certain digital currencies, such as stable coins and CBDCs, then the value of that currency is pegged on something else. For example, a stable coin will be pegged on either gold or the US. So that's why there's a USDT crypto. Yeah, there's USDT in crypto. Then there's the other, and then there's also Bitcoin from Ethereum, which is considered stable. And then there are other coins and currencies. However, it's also a matter of not regulating every single thing that you can regulate. Most African countries now have talked about cybersecurity, have laws or have policies around cybersecurity, and that is one of the major issues with regard to digital currencies and even mobile money, which is centralized, which is a centralized system. There's cyber fraud, financial fraud. There's a lot of fraud around any digital process. So strengthening of the laws that we already have, which I think most countries already have them, just strengthening them and implementing them as they should be, would go a long way in mitigating the risks around digital currencies. Then there's consumer protection and support. I think most central banks have expressed that the biggest concern is with cryptocurrency exchanges particularly, there is very little customer support. There's very little provision or guidelines with regard to protecting the customer or the consumer of their product. And I think if there are guidelines around what should anyone offering digital currencies, what should they meet? What criteria should they meet? And this could be in anything, a policy. It could also be in the consumer protection laws, which we already have existing. And for most crypto exchanges, they would not be fully compliant for the reason that most governments have issued cautions or warnings, so then they stay away. And that's a way to push them out of the legislative space, which increases the risk around digital currencies and crypto. I think my last point would be on maintaining privacy with transactions. Linda did mention something about data flows, and with these transactions, there's a lot of data being transmitted cross-border particularly, and there's need to protect customer data in the sense that there's a lot of financial information being put there, and financial information is sensitive data. This also needs to be balanced with the need to trace transactions to curb financial flows of cash.
We call for policies and practices that put people first. We call for policies and practices that put people first. You and I are the people.